Hi guys. Today we will analyze Capital One stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a bad performer in the overall market. The short-term trend is negative, the long-term trend is negative. There should be more interesting stocks out there. Support levels are around $124 and $114. The next support level is around $100. Resistance level is around $139. The next resistance levels are around $150 and $158. In the last month the stock has been trading between $124.70 and $160 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 3 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in downward trend since August 2021, be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why, our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average PE ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $376.54. When we apply the margin of safety to that value, the fair value of the stock would be $263.58. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Capital One is 26.84. Minimum rate of return. I will use 12%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Capital One, analysts forecast growth rate around 5% per year in next 5 years, and future PE around 7. I will use 3 different scenarios for Capital One company: bad, average, and good. First scenario. Capital One will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 0%. Future PE would be low, 6. In this case, the fair value of the stock today would be $58. Second scenario. Capital One will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future PE would be average, 8. In this case, the fair value of the stock today would be $93. Third scenario. Capital One will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 10. In this case, the fair value of the stock today would be $138. As you can see, Today the stock is fairly valued, $125, if we expect Capital One's high performance in future. The stock looks very valued. However, the revenue will grow only by 3 to 5% on average per year in the next 5 years. And the stock has been in downward trend since August 2021. I may consider buying the stock when it shows signs of reversal, or if it drops lower, the stock would be a steal at $100 in my opinion. Company's strengths. Ranked by assets and deposits, Capital One is one of the largest banks in the U.S., with top-tier national businesses in credit card, auto lending, retail and commercial banking. Capital One's mix of loans is about 40% card loans, 30% consumer loans, and 30% commercial loans. Successful track record of developing new products, product innovation. Management noted strong opportunities for customer attraction in the credit card space, and plans to lean into marketing spending in 2022. The company is well positioned for the long term in the credit card space. Successful track record of integrating complementary firms through mergers and acquisition. High level of customer satisfaction. Walmart and Capital One have begun a long-term credit card program in which Capital One will be the exclusive issuer of Walmart's private label and co-branded credit cards in the U.S. Risks. Capital One is a domestic bank that derives nearly 80% of its earnings from lending. As such, its results are levered to general U.S. economic conditions, primarily related to employment, consumer spending, and debt leverage. Data breaches are expected to remain a risk for credit card companies, with cybersecurity as a substantial ongoing cost. There are gaps in the product range sold by the company. This lack of choice can give a new competitor a foothold in the market. Based on estimates for the next 5 years, Capital One will show a small growth in revenue. The revenue will grow only by 5% on average per year. The earnings per share are expected to decline over the next 3 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.